CNBC-TV18.
Hello and welcome to Inside Out. We are back with a new edition. It is a show where we focus on individual stocks with in-depth analysis, deep dive into the financials, and tell you about the key risks and triggers going forward. Hey, Nigel.
Hey, Sonal. Good to have a new edition of Inside Out going. And, we'll be focusing on not just the key matrix that Sonal just mentioned. We'll also, ask questions that you want to ask. But, Sonal, let's not waste any time. I believe on your radar today, it's a company that post-listing has been a relative underperformer. So tell us more.
Oh, yes. So let's start with the deep dive segment. And the stock that I'm going to be focusing on is Fino Payments Bank. As you mentioned, the stock has been a relative underperformer. It listed in November 2021 at 5% discount to issue price of 560 rupees per share. And since then, there has been a one-way decline. It is a fintech company offering financial products that are digital with focus on payments. And the key products that it provides include CASA account, debit cards, domestic remittances, and micro ATM facility, to name a few. Now, the company gets a fee on selling these products on the platform, and that is the major revenue for the company. It has an asset-light model with a wide network of merchants like Kirana or small shop owners, and is largely a rural-focused payment bank with 70% of physical access points in rural areas.
Okay, all right. So now, tell us more then about the revenue breakup, because as you said, I think it provides a lot of services. So break that up for us.
It's a long list, Nigel, So the biggest chunk comes from remittances, which is almost 35%. This is followed by current account, savings account or CASA at 17%. Then we have Aadhaar-enabled payment system at 11%, BC banking, which comes in at around 10%, micro ATMs at 10%, and cash management services at 8%. In this, we have the margin breakup as well, with CASA earnings with margins of around 58%, cash management at 40%, we have micro ATM or Aadhaar-enabled payment system at 38%, and BC banking at 34%, amongst the other services that it provides as well. So let's do one thing. Let's get in the management and understand more about the company. We are now joined by Mr. Rishi Gupta, who is the MD and CEO of Fino Payments Bank, to take some questions. Mr. Gupta, welcome to the show. And as the show really goes about, right, we would first up like to understand your business model. What is the exact revenue source for you? Is it a fixed percentage or commission or fee?
See, Fino Payments Bank is a 6-year-old plus bank. As a company, we are 16 years plus as a company. Our focus is into providing basic banking services to the mass, the common people of the country. Our objective is that rather than setting up big branches and a big infrastructure, we have partnered with a lot of merchants across the country, somewhere around 13 lakh merchants across the country. Those merchants act as our banking points. Through the banking points, they provide banking services to the people who come to their merchant outlets to buy any item from their shop. So when they come to buy anything from their shop, they also do banking services. So banking services, which largely for us is the payment services, where we provide cash withdrawal services, money remittance services, CMS, bill payments, recharges. On top of that, we have also started to open accounts for the last few years. So we provide basic bank account for all our customers. And we have also now started to get into lending and investments through partnerships with other ecosystem players in the country. Being an asset-light model, we have been a profitable entity for the last 2.5, 3 years. Our objective is to grow the business, whereas we see there's a big opportunity. Somewhere around 600-700 million people have a very underbanked segment, so to say. Largely, our revenue comes from the fact that through remittances, which is one of our basic product, we provide nearly remittances worth 3.5 to 4,000 crore rupees a month. And that constitutes around 35% of our total revenue as on date. Out of the balance, roughly around 20-21% comes from the cash withdrawal businesses, which is your micro ATM and AEPS. Micro ATM is any customer who has a debit card of any bank can come to my point, and through a small device, he can actually withdraw the money very easily. Around 17% of our revenue comes from savings account, which is a normal savings account which we open for our customers. Here we issue a debit card. We have a novelty of issuing Hath debit card, and we can open an account within 6 to 10 minutes through the eKYC process. Another product for us, which is CMS business, has grown substantially. Both CASA and CMS has grown substantially from 16% last year to nearly 26% in this year. And CMS constitutes around 8% of our total revenue.
Okay, so Mr. Gupta, you talk about gross revenue and net revenue in your accounts. What is it net of? What kind of payouts are given to merchants? Is it fixed per merchant or per category? And do you also have an escalation clause in place for this?
Merchants is the backbone of our company. We provide all our services through the merchant network. These merchant networks already have a lot of footfalls coming to the shop. On top of it, because of the banking services, the people who come to do banking also buy some product through them. We have also provided banking services to the BPCL outlets all across the country. So that's the backbone. It's a very asset-light, scalable model. So they constitutes a larger part of our commission which goes out. So roughly, say if I earn 100 rupees, roughly about 65 to 70% of the 100 rupees actually goes out to the merchants who are there on the ground. The balance is where I earn the net margin, which is around 31% for the first 9 months. And at 31%, I have roughly about 21% is my direct operating cost, and about 5.5% is the depreciation and the financial charges. So I'm net with 5% net margin around that for the first 9 months. Merchant also has different commission for different products. So remittances will have a different percentage. Cash withdrawal will have a different percentage basis the revenue which is there. CMS will have a different percentage. But largely, I would say on an average basis, it's about 65 to 70% on an overall basis, so to say.
Well, so Rishi, CASA has the highest margins, but remittances are a bigger chunk of revenues. Will you change the revenue mix to move more towards CASA in that case?
So through that customer, 2.5 crore customers who visit us every month, a part of it, roughly about 2.5 lakh, we convert into savings account on a monthly basis. And also through the savings account, we issue them debit cards. So we are actually moving them to a digital journey. CASA, as you know, we have 67 lakh plus savings account customer on our platform right now. And we are adding about 2.5 lakh customers every month on an ongoing basis. So our endeavor is to increase the CASA from offers customer to honest customer. That's the plan which we are building on. And second part to your question, if I look at the migration which has happened, the numbers for CMS and CASA has substantially grown in the last couple of years. CMS and CASA used to be in the last year used to be 16%. Now it is 26%. So there's a substantial jump in the last 1 year. Remittances and cash withdrawal was about 63% as such. Now they are about 56% or so. So there's a drop in that percentage. So you can make out that we are moving from offers to honest customers. We are also moving from low margin products to high margin products. This is also seen from our growth in our profitability numbers, so to say.
Okay, got that, Rishi. We'll come back to you in just a bit. But Sonal, coming across to you. So how does this pan out in terms of financials?
Okay, so company has seen decent growth, Nigel, in terms of revenues, and despite that, there has been a sharp fall in the stock price. In 9 months, company is at 282 crore rupees, which is actually more than what they saw in FY21 in terms of revenues. These are net revenues that I'm talking about, because from gross revenues, merchants are given payouts as well. EBITDA in 9 months is already more than FY22, and profits in 9 months is equal to FY22 profits as well. So company is looking at a stronger FY23 already in place.
Okay, all right. Can you explain to us briefly what the company does in each of its segments? How do they earn their money in these segments? Okay,
now the product mix, it is dominated by retail at 80%. Let's start with micro ATMs. Here, a person in a rural India would go to Fino's merchant, use AEPS or that Aadhaar authentication, which will allow transactions via point of sale or MATM machine. This is enabled by Fino. And here, company has the highest market share at 51%. The domestic remittance market caters largely to migrant laborers who send money back to their families in rural and semi-urban locations. Fino provides infrastructure and services to facilitate these domestic remittances via its merchant network, branches or the other network, and the Fino BPay app as well. It holds around 14% share of the domestic remittance industry. Now, to the cash management services, they are provided to clients from banking, financial services, insurance and other sectors as well in this case, Nigel.
Well, got that, Sonal. But Rishi, coming back to you now. What has been the new customer acquisition run rate? It has increased from around 500,000 in Q3 FY22 to around 0.8 million now. How much can this increase to, and what is the outlook on margins and revenues in that case?
For us, the strategy is to move from offers customers to honest customers. CASA, which used to constitute around 10% of our business, now constitutes around 17% of our business. So we have built up a subscription product on which we charge a one-time fees for a customer rather than charging him on a monthly basis or on a transaction basis. So it's a very transparent way in which one-time charge is built for the customer. We have seen a good renewal rate on account of that. Roughly, we add about 2.5 lakh customers on a monthly basis. That's been our run rate for the last 5-6 months. We expect that now that we have stabilized around this level, we should see a growth of about 10 to 15% on this run rate over the next 3 to 6 months as we stabilize ourselves on this product per se.
Okay, got the revenue projections, but Rishi, what about margins?
So margin is, as you can see, the margin on CASA is substantially good. It's somewhere in the region of 58% if I look at the overall margin, including the renewal which happens, because the renewal cost is lower than the one-time acquisition cost which is done at the time in the first year. So we expect the margin to be in the same range. I don't expect that to go down. In fact, a part of the margin has come down because of the increase in the cost of the chip, or the debit card cost has substantially gone up because of the supply chain issues on the chip. We expect that over the next 12 to 18 months, we should see some supply chain ease happening on that part also. But right now, what we expect is the margin should be around the same levels at which we are currently.
Interesting. Rishi, own banking channel contribution has increased to 65%. Will you see it increasing further? What is the difference in the take rates or margins, say, between own banking channel versus third party?
Own banking for us is the bread and butter for us and the network which we have created across the country in the last 6 to 7 years. It had gone down at some point. We were at about 67-68%. We went down to 61-62%. Now we are at about 65% or so. Our expectation is that we should be within the 64 to 66% range in the short to medium term. Over a longer term period, we would expect that this should reach somewhere around 67 to 70% over the next 1 or 2 years. That's or you can say between 64 to 67% is what our sweet spot is on this open banking, own banking to open banking. Own banking margins are roughly 40% plus on an average basis, whereas the API margins are around 4% or so. So for us, it is important that we continue to build on our open channel, our own channel. Open banking channel gives me the advantage to work with a lot of fintechs and provide banking services through a host of customers. We right now are only providing payment services through that platform. Tomorrow, with the relationships and the network which we are getting from API partners, we can also look at expanding some other products through the same channel.
Okay, got you, Rishi. Well, so things look pretty okay from a financial perspective, Sonal. But what could be risk, that the company is faced with? Also, give us a brief outlook in terms of valuations and what is the current promoter holding?
Okay, so a lot of questions. Let me start with the risks first. Faster adoption of UPI payments. It could impact the business because then customers will not use their services. And we are talking about so many fintechs, right? So payment banks are increasing competition, which could result in higher merchant payouts, and it will thereby impact the margins of the company. So that is a possible risk. In terms of stock, it trades at 23.8 times FY24 EPS with no direct peer in the listed space. Promoters, they hold a 75% stake, and some interesting names hold the stock as well. Motilal Oswal Dynamic Fund, you have Fidelity India Focus Fund, Steinberg India Emerging Opportunities at 1.5%, Fidelity Pacific Fund. We also have Capri Global Holdings at 2.38%. So yes, some interesting names here in the list, Nigel.
Okay, all right, got that, Sonal. Well, Rishi, coming back to you. Will you change your concentration from north to other areas? I'll tell you why. This is a bit of a geographic risk. Go ahead.
First, on the geography expansion, when we started the bank in 2016-17, our strategy was to west to east strategies. So Maharashtra, Gujarat, going all the way to Bihar, Jharkhand, and West Bengal. So that was our prime focus, or the central India, you can say, was the prime focus. The states of UP, Bihar, and MP constituted about 50 to 55% of our overall business about a couple of years back. But we have actually expanded ourselves quite well in the last couple of years. So a lot of business is now coming from eastern part of the country, whether West Bengal, Odisha, Assam, and also from states like Karnataka, Tamil Nadu, and the likes of Kerala. Obviously, North, Bihar, Delhi, and Rajasthan constitutes one of our big business segments. So there was definitely Fino was concentrated more at 70-80% in the northern and the central part in the initial years. Now I would say we are equally spread. Roughly 40% or so our business comes from the north and the UP belt of it. Around 30% comes, 32% comes from the western and the southern part of it, and part of the southern part, and about 25 to 30% comes from the eastern and the southern coastal side of the southern part of India. So that's the broad geography on the geography expansion. So our risk is not there anymore on geography expansion. In fact, our strategy is now to leverage more into new geographies and new states per se.
Okay, Rishi, last question for you. The family office of Capri Global, a listed company, has a stake in you. Any word with them? Will they look at increasing the stake?
No, we have not met the management of Capri Global. I think they bought the shares from the market, and what I heard is that they are keeping in their trading book. So we have had no meetings with them at all since they have invested in the company, or before that also.
All right, thank you so much for joining us, Mr. Gupta. That was a deep dive into Fino Payments Bank. But Nigel, it's time to slip into a short break.
Well, that's right. We'll slip into a short break. But on the other side, we'll get to another interesting stock. Healthcare Global Enterprises is the stock on our Swotlight segment. Don't go anywhere.
Welcome back. Still tuned into Inside Out. This is our Swotlight segment. So Nigel, introduce the company that we are discussing on this segment.
Well, Sonal, the company that we're focusing on is Healthcare Global Enterprises. And before we get to the company's business, well, let's focus on the stock price move for just a bit. It's corrected close to around 13% from the highs that we saw in November. It's up close to around 30% though in the past 1 year or so. Well, the company is focused on providing end-to-end oncology care through its pan-India chain of oncology-focused specialty units. They operate 22 cancer centers and 3 multi-specialty hospitals, with the operational beds totaling 1,830 odd. The management believes that they are well placed to battle the increasing cancer incidence here in India.
Okay, so that is about the business, but tell us more about the operational matrix of the company. Since it's focused on oncology, I believe their occupancies were hit during the COVID period?
Well, that's right, Sonal. You know, their occupancies have been improving over the past few quarters from around that 40% odd mark to the mid-60s, though the average revenue per occupied bed has been range-bound around 37,000 odd. But that is because emerging centers have been growing at a faster clip than the mature centers.
Okay, explain that in a little more detail, Nigel. What is the difference between matured and emerging centers, and how do the operational matrix pans out there?
Well, you know, Sonal, emerging centers represent centers operational after 2017, while mature ones are obviously the existing ones which are there for a longer duration. Now, Healthcare Global has a large number of operational beds in the mature centers, while on the average revenue per occupied bed, there is a difference of close to around 10,000 rupees between the two. Now, comparing the Q3 FY23 with the previous years, the mature centers revenue is up by close to around 17%, while emerging center revenues, well, they are up by close to around 28%. However, the problem is that the emerging center margins have got diluted in the past 1 year or so. And that's evident because mature center EBITDA has grown at the same pace at its top line. But emerging centers EBITDA is up a mere 3%. Just to drive home the point, Sonal, the company reported margins of close to around 18%. But there's a big difference between the mature and the emerging center margins. From their mature centers, the Center of Excellence in Bangalore, that boasts of solid margins of close to around 28%. And the management has said that as the emerging centers transform into mature centers, the combined margins will trend towards 20% on a blended basis and then trend up to the mid-20s.
Okay, that is about the margins. Nigel, tell us something about the top line. What are the constituents here?
Well, for the past quarter, the mature centers contributed close to around 72%. Emerging centers, they contributed close to around 24%. While under the Millen brand, it operates fertility centers, which contributed close to around 4%. The company says it's focusing on market leadership in Bangalore and scaling up North India centers in the near term.
You know, Nigel, in the past few years, what has worked for the company is that they have been able to deleverage their balance sheet big time. It is owing to the PE infusion. Tell us more in this regard.
Well, that's right, Sonal. You know, they were on the verge of becoming debt-free in the next couple of years or so. Now, PECVC Capital Singapore-based investment arm, Assesco, has been betting on the company and gradually upping their stake. Initially, they infused capital through a combination of preferential shares as well as warrants. They further bought stake via the open offer route. And in June 2022, well, they picked up more than 1% at around 285 rupees per share from the erstwhile co-promoter, that's Mr. Ajay Kumar. Now, post the CVC capital infusion, their balance sheet is in far better shape. They have also appointed a professional CEO, halted new greenfield expansions, and also improved the workforce management measures.
Okay, so that is some interesting information. But Nigel, let's wind it down with the shareholding pattern and how do valuations shape up?
Well, Sonal, you know, the PE has majority stake. It could change hands in the coming years. That's going purely by the nature of a PE's investment. But let's bring up their shareholding pattern up for you on the screen. And also on the valuation parameter, it has some cushion if you're looking at FY25 EV per EBITDA. That's in comparison to some of its larger peers. There is some valuation comfort on that front.
All right, Nigel, that was some good information on healthcare global enterprises, but we have completely run out of time on this episode of Inside Out. So it's a goodbye from Nigel and I.
But you do write to us and tell us about companies that you want us to discuss. We'll try to feature them on our show. Thanks so much for watching.